Hello and welcome back to Not Financial Advice. Today we're going to be taking a look at the top 10 ETFs you can use tactically in 2024 and beyond. And this will be our first installment today. So I'm going to ask you to like the video, subscribe to the channel, and also turn on the bell notifications so the additional two parts are posted. You won't miss out on those either. Today, what we're going to do to start is take a look at my portfolio and just do a little bit of a daily update. Today is January 2nd, the first trading day of 2024, and the S&P 500 was down 0.6%. So giving back some gains from that awesome Santa Claus rally. It seems like the rally started early and maybe ending a little bit early as well. But what we can see is that today my portfolio is down around 0.9%, which is about $600. Um, the S&P 500 again was down 0.6%, but the Nasdaq was down 1.63%. So here, right around 0.9%, I'm kind of straddling between the S&P 500 and Nasdaq, and so we're going to look at the stocks that did the best today. That's going to be really important to frame this video, and it's going to tie together at the end of the video. So stay with me as you'll be able to see what I'm talking about. But on the first trading day of 2024, what we can see here is that defensive stocks, value stocks, these were the stocks that led the market today. And so Tyson Food was up 3%, up 3% rather. Same percentage gain for Dollar General. Kraft Heinz up 3% flat. We also have Walgreens up about 2%. Same thing with Johnson and Johnson. Pepsi up 1.8%. Berkshire Hathaway up 1.6%. And Vanguard Healthcare ETF 1.55%. So while the market was down 0.6%, all of these stocks or sectors outperformed pretty dramatically. Definitely a shift from how 2020 was as a whole. And so some of the names that did really well in 2020 are giving back gains. We have Coinbase down 10% today in my portfolio, but also members of the Magnificent Seven or a previous FANG stocks. Netflix down 3.8%. Down 3.6% was Apple. Down 2.7% was Salesforce. And then Meta was also down 2.2% today. And so what we're going to be looking at are different ETFs. All of them I own, but different ETFs that could be considered in constructing a well-diversified portfolio. So we're going to go through each one right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
All right, first up is State Street's SPDR S&P Aerospace and Defense ETF, ticker symbol XAR. Currently trading for $133. We can see that this ETF is up 68% over the last 5 years. So something like 12% gains a year over the last 5 years. In the last 365 days, XAR is up 21.5%. And you can see here when the troubles in the Middle East started, it gained quite a bit, unfortunately, due to those circumstances. But this is the way of the world. And so this ETF has performed relatively well this year. And so let's get over to the issuers so we can learn a little bit more together about XAR. So firstly, what is an ETF? It's a basket of stocks, and it's usually stocks that have something in common or are from a particular country, if you weren't aware. But when it comes to this ETF, XAR, what it's tracking is aerospace and defense stocks. So these are war stocks. These are companies that provide products and services predominantly to the US military. And so when thinking about the overall market, there are 11 or 12 sectors in the S&P 500, and 4 of them are considered defensive sectors, which would include aerospace and defense. And so with the 4 defensive sectors in the S&P 500, these sectors are ones that generally are not cyclical. Um, they're ones that also can have durable earnings during a recession. So the government is going to continue to be militaristic in a recession. And so that's what defensive sectors means. And this ETF is the first of four that we're going to be looking at. They all fit together. So I thought I'd highlight these ETFs together today. So XAR, what this is a ETF with an expense ratio of 0.35%. Um, and I'm going to touch more on that in 1 second. But assets under management, $2 billion. So not a tiny fund by any means, not the biggest either. But what we can also see here is XAR seeks to track a modified equal weight index, which provides for the potential of on concentrated industry exposure across large, mid, and small cap stocks. And so this is a little bit of a different approach to the aerospace and defense industry. Most aerospace and defense ETFs, um, they happen to have a higher expense ratio, but they also are more concentrated into older blue chip only type companies. But I think that aerospace and defense, I think technology is a big part of it. And so I see small cap and mid cap companies in this area, growing higher and being able to capture those profits within XAR. And so that's that. But as we continue to learn a little bit more about this index, we can see that it's been around since 2011. We can also see that the ETF XAR has 34 holdings, which is pretty concentrated, but there aren't necessarily a huge amount of companies in this space either. What we can also see is that it's fairly expensive with a PE ratio of 25. And that's because of its exposure to some of the small and mid cap stocks that sometimes can be a little bit frothy. But again, a really high multiple on price to cash flow, which is something to be aware of. And so as we look at this, we can see that XAR pays a pretty small dividend, 0.44%. That's paid quarterly. So, additionally, what we can learn about this company will be contained within its top 10 holdings. And so, to be completely frank, I'm not super familiar with Spirit Aerosystems. I'm not, but it is the top holding in a fund that I own. And that's just sort of the nature of ETFs. But there's also Axon Enterprises. I believe this is the company that makes body cams and drones, but not entirely sure. And you can sort of see how these are weighted. Again, pretty high concentration in the small ETF portfolio, but L3 Harris, Boeing, Texatron, and then some other familiar names like General Dynamics. So these are the holdings in the top 10 and their weightings as well. So let's see what else we can learn. I'll ask you to like the video and subscribe to the channel. And we're going to come over here to Morningstar, which, if you didn't know, is a really helpful resource. It's kind of like the Reader's Digest for stocks, I guess I would say. And one thing that I can find to be helpful are their analyst ratings. And so XAR has received a medalist rating of 4 of 5 stars, which is a silver, which is quite good. And so what we can see here is a little note that they've placed on this ETF. So a strong management team and sound investment process underpins XAR and their Morningstar medalist rating of silver. And so, as I alluded to earlier, the portfolio maintains a cost advantage over competitors, priced within the least expensive fee quintile among peers. And so, let's take a second out to talk about expense ratio. This isn't something that you pay, it's just gains or profit that you otherwise would have seen that are siphoned off of the back end. And so, you have to be cognizant of that, but that basically is paying State Street to maintain and offer this ETF. So that's what an expense ratio is. 0.35 is the most expensive ETF that I own. It's quite high, and you look for something, 3, 4, 10 times lower than this in expense ratio. But just a note on that for your information. And then what we can see here is XAR contains 40% of their total holdings within the top 10, and that's not uncommon with ETFs. And so the other 24 stocks are a much lower, probably less than 1% allocation. So going over here, we've now sort of done that high level overview of XAR. And now we're going to be taking a look at the second ETF we're going to be discussing today, which is Vanguard Healthcare Index ETF. And so we can see that this medical and healthcare company ETF is up about 60% over the last 5 years. So pretty similar performance to the previous one, around 11 or 12% a year over the last 5 years. And in the last 12 months, we can see that this fund is up only 3%. And so it's had reasonable performance over the last 5 years. And when you see something that's historically done pretty well with some pretty high quality assets inside of it that doesn't do well in a year, but it's done well over the past five, as long as it's nothing too wacky, you could kind of look at that as a coiled spring and anticipate stronger returns. The market takes turn switching styles and sizes and things like that. But VHT did participate in the market rally, up 14% from its lowest low this year. So let's get over to Vanguard's website, and we're going to be able to learn more about VHT. Um, First thing we'll see is the expense ratio being a lot more reasonable at 0.1%. And then we can also see that it has a much higher yield, close to the markets, a yield of 1.45%, which will also be paid quarterly. And so this is a passively managed index ETF. What that means is it's different from a mutual fund where some guy gets paid a lot of money to buy and sell stuff really quickly. This is something that's just sort of based on a set of rules, and it just runs in the background. That's what you're going to be wanting is index or passive ETFs. What we can see here is that VHT seeks to track the performance of a benchmark index that measures the investment returns of stocks in healthcare sector, passively managed here as well. And then what we can also see is it includes stocks of companies involved in providing medical or healthcare products, but also services, technology, and equipment. And so, what else can we learn about this ETF? That this ETF has 424 stocks in it with an average market cap of 112 billion. So as opposed to XAR, these are going to be mostly large cap stocks. And so we can see here a PE ratio of 28, which is relatively high, but not unjustified. If I thought it was, I wouldn't own it. But we can also see some other metrics. All the holdings are domestic within the United States. And so this is really cool. This actually breaks down into subsectors. You can see here is that the largest segment of VHT is going to be in pharmaceuticals. And then we can see biotechnology is in under that, managed healthcare, healthcare equipment, life science tools and services, and healthcare services are the majority of the sub industries within this ETF. So, lastly, let's see if we can see some of the names that are within this company. And so, at nearly 10% of this ETF, you have United Healthcare, a health insurance provider, and then you have a pharmaceutical company, Eli Lilly. Johnson and Johnson is a little bit of a diversified company. But obviously in the medical space with medicines and other products, devices, Merck and AbbVie, mostly in the pharmaceutical space. But then you have Thermo Fisher Scientific, a company that makes devices, Abbott Laboratories, Pfizer, so on and so forth. And so with VHT, when we come over to Morningstar, we'll also see that it's earned a medalist rating of 4 stars, silver. And so what we can also learn is that Morningstar says VHT is using a sound investment process with a strong management team underpinning Vanguard VHT ETF's Morningstar medalist rating of gold. Okay. So The portfolio maintains a sizable cost advantage over competitors, priced within the cheapest fee quintile among peers. So you're seeing a common thread. This is part of how I select ETFs and why I selected this one. So when they say it's cheap, they're not talking about the stock price, they're talking about that expense ratio again. So now we're moving on to the third of four ETFs that we're going to cover, and it's Vanguard's VPU. So this is a utilities ETF. So the company that you pay your gas and water and electric bills, basically. Before I break this down for you, I'll ask you to like the video, subscribe to the channel, and turn the bell on. But what we can see here is something that's pretty interesting. Pretty poor returns over the last 5 years on this fund. Only 18% over the last 5 years, to something like 3 or 4% a year. But this one also pays a healthy about 3% dividend yield as well. So total returns are decent. But in the last year, it has done a lot worse than this. So down almost 10%. And you can see a really sharp bounce. So 2023 was the year of the Magnificent Seven, but you're seeing a 14% swing in a stock that's only done 15% or 18% over 5 years. And so this is one I'm betting on fairly big. Um, Oftentimes, a high quality asset that does poor in year A may do better in year B. Okay, so let's get into it. Vanguard's website on VPU shows us another reasonable expense ratio for a sector ETF and a big yield of 3.5%. Okay, so good dividend payer. With what's going on with bonds, with interest rates being cut, that's going to likely reduce the yield on bonds. And so this is part of why VPU did bad in 23 is people were able to park money in money market funds and get 5% easily. But with interest rates being cut, interest or coupons on bonds and money markets should go lower, which makes higher paying stocks or ETFs, stock ETFs that pay a 3.5 or 4% yield makes them more attractive, which could cause inflows. But again, this just like VHT and XAR, utilities is another one of those defensive sectors within the S&P. And so if times are bad, be it a recession or a bear market, people are going to pay that light bill. They're going to pay that light bill maybe before they buy clothing or jewelry, for instance. So what we can see when we're looking here on this website, let's just see what we need to see. Pretty straightforward stuff. I think I broke it down pretty well. I think we can see 65 stocks within this ETF, a market cap of 33 billion. So still large cap, but a little bit smaller. A lot of these are going to be regional companies, so that's kind of cool. Kind of diversifies a little bit. A little bit of a more reasonable PE ratio, 19.2%. And what we can see here is electric utilities, so that light bill, that's 62% of it, with multi utilities being 26%. Okay, so we'll get the last word on VPU from Morningstar, a 4 out of 5 star ETF. And so they have similar things to say about this as they did the last one. Um, and again, priced within the lowest quintile fee among peers for expense ratio. So lastly, guys, we're going to talk about VDC, Vanguard Consumer Staples Index Fund. Now, I'm not going to be spending as much time on this because if you're like me, just a regular guy, you utilize a lot of consumer staples. And so that's things like mouthwash, toothpaste, pop is what we call it in Iowa, or soda for all of you other people. Potato chips, salt, pepper, seasonings, paper towels, all of these types of products, even tobacco products or different, band-aids or personal care type products. These are what consumer staples are. And so, you always have to have an edge in investing. If you know more about one sector or segment of the economy than some random person on Wall Street does, for instance, if you're a doctor or a nurse uh, in that field, you are pretty well qualified if you can, follow along in the same way I do to pick individual healthcare stocks. If you're a doctor, you probably know more about how different brands are providing value than some junior analyst on Wall Street. And so the only edge that I have as a regular guy are in these consumer products. So I own a lot of the companies individually. And that's why I said earlier in the video, pay attention to which ones are doing really well today. And so I don't own VDC because I own individual consumer staple companies. But with that being said, it has performed okay in the last 5 years, up 46%. And in the last year, pretty poor performance, up only 1.1%, but moving along with the market up 10%. And so this may or may not be one that has some outperformance in 24, as it's done well over the last 5 years, but poorly in 23. So that kind of is wrapping up this portion of the video talking about the first 4 out of 10 ETFs that I own and I think can be used to diversify a portfolio in a smart way. And so I'm going to ask you to like the video and subscribe to the channel. And the way that we're going to wind this down is coming over to a really cool website called Backtest Portfolio Visualizer. And so what we're going to be able to do here is I've inputted all of these ETFs and I've gone ahead and back tested to see what the results of these investments were. And so I went back to January of 2012 because that was the first time that one of the ETFs was available. And so we can see how the returns would have been if we put in $1,000 in January of 2012 and $100 a year each and every year after that. And so I've split in these 4 ETFs we discussed: XAR, VHT, VPU, and VDC. I've split them into equal weight positions. And what we're able to see here is a couple fold. So what we can see is that um, the overall market, since whatever data I just told you, is up 13.8%. Well, these 4 defensive sectors are up only 12.4%, which is still fantastic. But what's going to really sort of be illuminating to you folks is what we're seeing here is there was an 18% total bear market in 22, but this ETF only went down 3.5% while paying a high yield. And so we can see that this is just a little bit of a ballast, something that a younger person could use one or all of these funds as a bond substitute. In so many words, there will be more volatility, but they do move in different directions. And so, if you got value out of today's video, like it, subscribe to the channel, turn on the bell notification on your way out. If there are any questions or anything you'd like to get some clarity on from me, or any comments whatsoever, just leave them down below, and I will see you on the next one. Thanks. Bye.